Welcome back to Dividend Stockpile, where we talk about all things dividend and income investing related. Today, we have a very special returning guest, Troy Cates, the co-founder and managing partner of NEOS Investments. NEOS Investments is the firm behind the funds such as SPYI, QQQI, BTCI, and the fund we're going to talk about today, NUSI. So Troy, welcome back to the channel.
Thanks for having me today. Happy to be here.
Awesome. Thanks so much for coming. So we met about 3 months ago. We talked about some of your other funds and the background of NEOS, but today I want to talk about one specific fund that's been kind of going through a little bit of changes. So I wanted to introduce it back to the community and give your company and yourself an opportunity to kind of talk through what NUSI is all about, kind of the path forward, and your approach to NUSI at this point. So can you kind of talk about kind of NUSI, what it stands for, what your basic strategy is, and maybe some of what's changed over the last couple of years?
Sure. No, thank you for the opportunity. So NUSI has been around since December of 19. It used to be a nationwide ETF product. And Garrett, my co-founding partner, and I were the sub-advisors at another firm since inception. So Garrett and I have been managing it since 2019. And through those years, we've had some really nice performance years. And then we had, which you and I have talked about, a rough 22. And it wasn't really the entire of 2022. It was really the first 6 months of the year that set the strategy back a little, in the sense of it used to be a net credit collar where you were selling a call and buying a put on a monthly basis right before the normal index option expiry, which is the third Friday of the month. So it would roll on a monthly basis. And during that time frame in 2022, there was a period of market declines during those monthly timeframes that were really never hitting off, or the insurance was never paying off. So if you were buying a put 5 to 10% out of the money and the market was down 4 or 5%, the insurance was never paying off. So you were really absorbing those losses in that beginning part of 22. Coming out of the second half of 22, the strategy started to perform a little better. Nothing changed, but it was really that market anomaly. And we did some research looking back to the inception of the NASDAQ 100 to really see what was going on. And it turns out that markets like that, where you have month over month declines of the similar, 4, 5, 6% month over month, really only happened 3% of the time since the NASDAQ 100's inception. So for us, when we're building these strategies, we're really looking at probabilities, and we are always going to lean towards the probability of a 97% outcome versus a 3% outcome. So we continued to manage the product. It had a really nice performance in 23 and 24. But over the last year, Nationwide was moving away from wanting to manage ETFs. We wanted to still manage the ETFs as we were growing NEOS and the products you mentioned earlier. And so we wanted to take over the product. We went through a proxy process where we proxied all the shareholders as of a record date, and eventually got enough shareholder vote to bring it over and change it to a NEOS product. So now it's the NEOS NASDAQ 100 Hedged Equity Income ETF. With that change, that name change, we've also changed the option strategy slightly. So if you think about what's in the product, you're still long all 100 plus names of the NASDAQ 100, similar to before. But instead of that net credit collar, selling a call, buying a put, we've changed it to a put spread collar, where we're still selling a call out of the money, and then we are buying a put spread. So we're buying a long put somewhere around 5% out of the money, and then we're selling a short put a little further out of the money. So in that put spread, where you're buying that put and selling that put further out of the way, you're giving yourself a measure of downside protection, but you're also giving yourself a little bit more income with that sale of the call out of the money to help you bring in and distribute a little more income.
Okay, awesome. Yeah, so that's quite an interesting change. So I used to own NUSI back in 2021, 2022. And as everyone can remember, the NASDAQ specifically had a really bad 2022. It came off the highs after COVID and then had a really rough time. So it's not too surprising that, NUSI had a rough year that year. It's very interesting that, the setup that you guys had for the protection didn't quite trigger, and that's really what caused the the share price, I guess, of NUSI to go down during the year. But since then, I was looking at the returns, and you guys have done extremely well pretty much over the last 2 years. Can you kind of talk about what you think changed, or what was different between then and the first half of 2022?
Sure. I think coming out of that early part of 22, where you saw this more of a market anomaly for the NASDAQ 100, where we saw those month over month sell-offs in that same kind of range where our long insurance, that long put, was not paying off. I think you got more into a normal market cycle, which is how the strategy was more built to manage around. And yes, you saw good performance through the end of 22, and then into 23, really nice performance. And then I know we talked about it before the call, but in 24, the product returns just over 100% of what the NASDAQ 100 did. I'm not saying that's a normal year, but just the way the roll cycles worked and how the NASDAQ was up, about 25%, the product NUSI was up about the same. And yes, the strategy did change about 2/3 of the way through the year after the proxy process happened. But I think what we're trying to do with this new put spread collar is give you a measure of downside protection and still be able to give you some upside movement. So when you're thinking about our put spread collar, we're selling a call out of the money, and we're using a lot of the same strategies that we're using in, say, our other products, SPYI, QQQI, where we don't need to overlay on 100% of the notional on that short call. So that short call is not covering 100% of the notional. And then we're using some of that premium to buy that put spread, where we're, again, buying a long put 5% out of the money or so, and then selling a put a little further out of the money. And with that, we're getting that measure of downside protection, but we're also keeping a little bit more premium. And you'll notice that the distributions used to be in the 7.75% to 8% range. Now it's more in the 8.5% range annualized basis. So we have a little bit more to distribute, but looking to smooth out the return profile and hopefully capture more of the upside by not covering 100% of the notional on that short call.
Yeah, that's really good, because a lot of the covered call ETFs out there do at 100%. And so you don't get that upside potential that you're allowing by not doing 100% of the portfolio overridden. So when it comes to the options and the incomes, you get income from two different ways: selling the calls and selling the puts that you mentioned. You're also taking a small portion of that premium that you receive from the selling and buying a protective put. In case the market goes down, you have some level of stability or protection. Is that kind of the basis behind it?
Yes, exactly. We also, I know I mentioned earlier, we had that roll cycle where we were going from expiry to expiry. We changed that roll cycle more to what we're doing on the other NEOS products, where we're rolling at the end of the month. Duration goes out about 6 or 7 weeks, but we're closing and rolling again at the end of the month. So when we're rolling at the end of the month, there's still, call it 2 or 3 weeks before the options would have expired. So it's a different roll cycle than it used to be. And we've noticed we can capture more of the income, the premium that we're bringing in, but also help protect a little better on the overall portfolio.
Yeah, that's great. And that's why I love NEOS, is because you guys are actively managing these portfolios. You're identifying what works and what doesn't work. And, as opposed to us trying to do it or doing 100% like at the money or whatever it is. Like, you guys have a very specific formula that you follow to hopefully capture the best of what the market's giving you at the time. So I was looking on your distribution history, and it looks like the December distribution was pretty significantly higher than previous months.
For NUSI, so we distributed about just under 19 cents for December. So maybe you're looking at one of the other ones. But for NUSI, it was just about 19 cents. So if you look, November was around the same, but if you look back in October or previous to that, that was when before we changed the option roll and what we're doing. So you can see we're getting, we went, like I said, from an annualized distribution of about 7.75 or so. Now it's more around 8.5 to 8.60, where it's currently sitting right now.
Okay. Yeah, it looks like for people who are relying on the income, that 1.5% increase definitely will make a difference over time.
Yeah, no, we think so. And we think, with a little bit more income, smoothing out the return profile, and still offering a measure of downside protection. Again, this is a long put spread. It's a put spread collar. So that long put spread, we're not hedging it to zero, but we're giving you sort of a buffer from, a little bit below flat to down, 10 to 15%, where you could protect the portfolio a little on some of these months where the market moves down and then bounces right back. So it's a little bit different than the strategy used to be before.
Yeah, no, it sounds really good, especially with the fact that the NASDAQ itself is up so much over the last 2 years. There might be a lot of volatility going into this year, after the election, inauguration, the different changes in economic policies and other things that are being proposed. You might see a lot of volatility this year based both on valuation as well as, changes in the regulatory environment. So having that downside protection, to your point, might smooth out the ride a little bit. You still get exposure to all the NASDAQ 100 names that we all have come to love, So it sounds like a really, really good strategy. So I was looking on your website, and it talks about the type of options that you guys do sell. And if I have it correctly, you sell it on the NASDAQ index itself.
Correct.
And so you get a better tax treatment. Can you
Yes.
talk about that a little bit?
Sure. Yes. So we're using the NDX, the NASDAQ 100 index options, and those index options get that designation under the IRS of Rule 1256, which gives you 60% long-term cap gains, 40% short-term cap gains, no matter the holding period. So with us rolling on a monthly basis, there's always going to be a P&L associated with that. But it's nice to get that added tax benefit of getting that 60-40 split. So when you get your 1099 at the end of the year, that's all going to be baked into the 1099, whether it's long-term cap gains, short-term cap gains. And we've talked about this before, but wherever we can and wherever the tax accountants can, we look to harvest some losses and make sure a portion of that can be considered return of capital, even with the product being up just as much as the NASDAQ 100 was for 24. If a portion of those distributions throughout the year can be classified as a return of capital, that net after tax distribution will be a lot closer to the gross distribution for the year. And you'll see that on your 1099.
Yeah, so that's one thing I love about the different option strategies that you guys employ is that you do have that tax benefit. For us as individual investors, if we're doing call options, put options, the premiums that we receive is taxed at our regular taxable income rate. But because you guys have the size and the exposure to the NASDAQ index, you get that favorable tax treatment, which goes a long way when you're looking at your net income that you get for the year. If your taxes are less, that means you keep more of your income, which will help a lot of the income investors out there, especially those who are relying on the income. And that's very different than some of the other names out there like HYBI and things like that, where they sell 100% at the money on the entire, NASDAQ 100, and you don't get that same tax treatment, if I'm remembering that correct.
Yeah. So if you think about it, for us, now a lot of people have started to ask, like we have NUSI, we're adding another NASDAQ 100 product because we also have QQQI. So we look at it as QQQI, you're taking a little bit more equity risk, but you're going to get a lot more income off that. We're not using some of that income to buy any downside protection. So for QQQI, we're just selling calls out of the money on the NASDAQ 100 using those same index options to get that tax treatment, but you'll get a higher distribution yield. For NUSI, thinking about it, for people who still want that exposure to the NASDAQ 100, but don't want to take as much risk, they're willing to give up a little bit of that income. And for that, they have a measure of downside protection and maybe a smoother return profile. So for us, we're really excited about having two NASDAQ 100 ETFs out there, both providing income at different levels for different market exposures, whether it's QQQI with a little bit more equity risk, but maybe some more upside, or NUSI with that downside protection.
That's great to have different options for different people and different risk profiles. I personally own QQQI as one of my biggest holdings, but my timeline is still pretty long, so I can adjust to the ups and downs. But someone who's maybe relying on the income or is more of a conservative investor, the NUSI product might provide a better fit. You get a lot of the income, but you still get some of the downside protection, as well as you're participating in the overall market upside. And the reason why you guys can do the tax loss harvesting is because you own the individual names, not just the index as a whole. Is that accurate? Yeah,
so we do own the individual names. A lot of the tax loss harvesting does come through really on the options portfolio. So when you think about, we can go through for a minute. If you think about a year like 24, where the NASDAQ 100's up, call it 25%. So those underlying equities are moving higher. you might have a associated P&L, as we were talking about earlier, with the options as we roll them on a monthly basis. The profits will pair off with some of the losses and so forth. But if the market keeps moving higher, there may be more losses in that portfolio, even though you're bringing in dollars to distribute out. Those losses inside an ETF can be carried forward indefinitely. So during times of when you have a net loss on the overall options portfolio for the year, but we distributed out income, a portion of that income might be considered a return of capital, even though your overall NAV has and your price appreciation has moved higher. So it's a constructive return of capital. We look at it as not so much, we're not looking to return principal, but if we can get that tax designation of a return of capital, that makes a big difference when you're thinking about the tax loss harvesting. And then at the end of the year, eventually what your 1099 looks like and what you have to pay in taxes.
Yeah, that makes a lot of sense. After tax income's where it's at, especially as we're approaching tax season this year, people are going to start realizing how much taxes do they owe based on their products from 2024. And so when they're thinking about how to address their tax situation for the upcoming years, something like NUSI can help balance that out a little bit more. It sounds like give you a better after-tax return, hopefully.
Yep, absolutely.
Awesome. That's great that you guys are continuing to innovate. You're taking products who, may not have had a market, or, the fund manager might have wanted to do away with it. You're reinventing it and providing, a great option for the community of investors out there. So as right before we wrap up, I know you guys have quite a lot of other ETFs. Are there any other ones you want to highlight right now? I know you have a couple new ones. BTCI came out recently. I absolutely love that one. That one's done really well. But anything you want to talk about?
No, we're really happy with BTCI. We did also launch a 20-year plus treasury. It kind of pairs along with our 1 to 3 month T-bill ETF, which is CSHI, which we've had out for a couple of years. So we wanted to get a longer duration one out there. So that's TLTI. That one, 20-year plus treasuries, plus a put spread overlay to enhance that income on a monthly basis. We also are looking to launch in the next few weeks our NEOS real estate high income ETF. So we'll hopefully come back soon and be able to talk about that one. We're really excited to get that one out into the market. Outside of that, yes, we're really excited about our Bitcoin fund and all of our funds going into 25. So we're looking forward to a strong year.
Awesome. Now going back to TLTI, I know you guys have been building your product suite. Is there a reason why you chose TLTI right now, or was it just the way the timing worked out? Because I know obviously long-term interest rates are in question. TLT itself has been down over the last couple of years. Is there any kind of timing related to that, or just how it worked out?
I think as we look at the asset allocation, we're starting to slice the pie more and more. We have a number of equity products out now, just like we talked about NUSI and QQQI today. We have some fixed income products out with HYBI and BNDI, and our ultra short duration kind of sitting in that treasury category, CSHI. We've been seeing a lot of interest from clients looking for a longer duration, looking for that 20-year plus, thinking about as the Fed really starts to cut, what is 25 going to look like? And so we wanted to have that option out there for you to have a 20-year plus, and whether you're mixing some of the ultra short duration with the 20-year plus and kind of toggling that back and forth to find your perfect mix. We really wanted to have that out there. And I think for us, we've talked about this before, we look at ourselves as a solutions provider. So we're not trying to pitch you on one fund or trying to sell you on one fund. We're saying, what kind of income are you looking for? What kind of risk are you looking to take? And hopefully we have a solution for that. So we really are looking to get more products out in the marketplace that make sense at the time and going forward. And we really like to bring out one product at a time and really focus on that, support it, make sure we can help it grow. We don't really bring out a ton of products at once. We really like to spend our time thoughtfully bringing out products. So we just, like I said, TLTI was one of the recent ones that we just launched right before the holidays, and looking to get out the real estate fund in the next couple of weeks. So we're really excited about those.
Yeah, I'm really excited about the real estate one too. As I've read the preliminary prospectus, and it looks like it's going to be a really good fit for my portfolio specifically, but I think it's also going to fit a lot of people's income portfolios, and it's going to diversify away from like the NASDAQ and the SPYI. type of products having the real estate in the REIT sector. So I'm really looking forward to that one. That's why I love your guys' company. NEOS is one of my, if not my favorite ETF company, because of all the different great products you guys offer. So I'm really looking forward to what you guys have coming up in 2025, and can't wait to talk to you more about the new real estate ETF you guys are coming out with in a couple of weeks.
Yeah, appreciate that. Well, looking forward to talking about it soon.
Awesome. All right, well, Troy, thank you so much for coming on the channel again, talking about NUSI and some of the other products you have. Hopefully the community likes the new approach. If you have any questions for Troy or any feedback, or if you currently hold in USI, definitely leave a comment below and let us know how it's going and what you feel. And if you have any other questions for Troy, I'm sure that he would love to come back on and answer some questions about the different funds. So Troy, thanks again. Appreciate it. Have a great 2025.
Thank you.
Thanks.